Hello traders, Matt Chapman here. I'm the creator of the trademarked Trap Traders concept. Welcome to today's Trap Traders Trade of the Day analysis. Today's date is the 29th of November 2016, and the trap we're going to look at today, which is currently occurring and playing out in this area here, is a trap break pullback. This was a level of support historically. I think it's been touched several times. Comes into the level, it breaks, then it becomes resistance. It's ever so subtle, but as it pulls back, it then sells off at the level, so there's your resistance. It then breaks back up through that level and then becomes support. Not in a major way, but it's there, it's nuanced as that candle goes up. It then breaks down through that level, then becomes resistance as it trades back into that level and then sells off. And then back into that level and then sells off. So now we've got a level that people are trading off, was traded off in this location here when it touched again, and it looks as if it's starting to sell off again here. Now the way that you trade traps successfully is we hack the major trading disciplines of the vast majority. So what that essentially means is we take the trading strategies that most people trade and we hack it. We understand it, we understand the psychology of it, we understand the behavior of it, how people behave in and around these locations, and then we actually witness them taking trades. And the element that is so critical, once we've done the analysis and we've discovered an area where people are trading off, is this here. It's the entry cheese, it's the price action at the hard right edge that makes it look as if this level is actually going to hold as resistance as it comes back in again, right? So it starts to sell off, and that's what makes you actually commit some money. Because if this was just to trade up from here and strongly break up through the level, no one would take that trade. And that's what I'm talking about when people have to place themselves in the shoes of the traders who trade at these locations, the type of trader. So some type of retracement trader off a level, some type of level trader, etc. Understanding what they do and then witnessing when they come in off the sidelines and actually take some risk. And that can be boiled down to that location there, because that would be enough for a very many amount of traders to actually take that trade, believing that it was going to sell off as it had done there, as it had done historically every time it touched the level. However, once the trader took some risk and had assumed that this was going to go lower, they placed their stops above these locations, maybe above that area there. At a push, maybe they went above that little area there, but basically they're going to either put it in one or two or three of these localized areas. Maybe someone went way out there, but the vast majority will try and there'll be like a build-up of stops quite close to the price action. If you're able to see behind the screens and see where people were placing their orders for stops, you'd see that these areas will be more dense because people are trying to take real tight entries so that they don't have to risk too much, whereas up here there may be less people willing to do that, so it'd be more sporadic, and then you get a few more a little bit closer to price, and then so on and so forth. But this would be the most dense example of that. So it looks as if it's selling off at the hard right edge. So this is what gets you in to commit some money, but no sooner do you do that, this happens. Okay, so now we go to the reality of it, and now these traders are being squeezed. So some of them are being stopped out, and that's going to create buy-in, because if you sell, i.e. if you sold in here believing it was going to go lower, the opposite transaction is true of your stop loss. Whatever transaction you took in that direction, the opposite is the transaction that you take to liquidate the position. So if you sold originally hoping it would follow through, you must buy to exit, right? So let me just write that: buy to exit. Okay, that creates more buying, right? Creates more demand. place yourself in the shoes of the trader who went short in here and is now being squeezed as the price action goes against them, right? Some indecision, not sure, pain, right? All the emotions of that, the stress, maybe the too much risk. So this picture ultimately equals and can be best described as a real edge. Because there is no doubt, there can be no argument that those who went short, sold in here, are now losing money, right? It's non-defensible, can't be argued either way, it's just a fact. Now some maybe stopped out, are definitely still in those trades, because what we know about traders and humans more broadly is that humans tend to make mistakes. So if they did have a stop above that structure, hoping that, you know, they could get a nice tight entry and then they could trade this to new lows, the problem is that humans hemorrhage outside of process. So imagine this is the process box and the job of the trader is to remain inside the process. What happens is the hemorrhage. Okay, so when they're under pressure, and especially when they're under pressure and they're losing money, right? That's when you start to make mistakes. Your efficiency of execution starts to dramatically drop away. If you've taken too much risk, that's going to magnify, it's going to intensify this process. So then it may be that once you've cancelled your stop loss, you maybe add into the losing position. It just gets worse and worse and worse. You compound it. Now this is a situation, as I say, where an actual real edge, which is forged in human behaviour and human weakness as well, and the process, the trapping mechanism that the market is, it just is, but by way of the different elements coming together, i.e. the setup looked great, the entry cheese presented itself, the hard edge creates this optical illusion that people don't really focus on, and so does the entry cheese, and then it goes against them, then they're in trouble. It's one giant huge trapping mechanism. This is essentially how we trade traps. This is just one trap in particular. This is the trap, and then it's breaking up against them, pullback. So if this pulls back, this doesn't look like a terrible place to get long. Make sure you check the news wires, make sure that all adds up. Just be a little bit careful. Friday we do have a non-farm payroll, but I've identified in excess of 20 traps. And if you'd like to learn a little bit more about this type of trading and how you can hack people's trading strategies, then please click the button below. This is why most of the trading strategies fail, because trading profit is made by taking money from others. But the thing is, when you're taking money from others, they've got to believe and would only act to risk money if they believed that it was the right thing to do ultimately. Once they commit, because they believe it's the right thing, all the books, gurus, courses, so-called gurus tell you to do that. You're in with your money because the entry cheese confirmed it. You take some risk. Now that transfer of accounts can take place. Your money is now at risk. Your money is now fair game. So if you'd like to be on the other side of that equation, which I strongly encourage that you do, click the link below, and I'll see you on the other side. Take care.